Hi, this is JB Cycles with an update on my longer term scenario based on the 28-year cycle and the 3.5/7-year cycle. So I'm not announcing this video anywhere, so I'm curious if any of you will find this one. Excuse me. Okay, here's the monthly chart for the S&P. And I have drawn the 20-month moving average and the 40-month moving average. So we have sliced through the 20-month average, and I'm looking for my first target is around the 40-month moving average. And as we see in strong uptrends, that's where we make typical a bear market low at around the 40-month moving average or 42-month. We didn't quite make it here in 2015, but when I'm looking at the daily data and the same average there, it came down there. Here it almost came down. The COVID panic was not supposed to happen. So generally that's where the market makes a low in these strong uptrends. Here we didn't get quite down there, and in 1998 we absolutely didn't get down there. But where the 28-year cycle has topped or is going down, we should expect to break below further. So we saw here in after year 2000 we quickly came down to the 40-month moving average and actually broke down below. In 2008 we found support there before breaking down lower. Here 1980s found support but then broke lower. Here 1968-69 we found support before breaking lower. In the 73 case, in the monthly data we didn't quite get down there, but in the daily data we were very close, so found support around there before breaking lower. So that's my expectation here. We shouldn't see any big rallies before we have gotten down closer to the 40-month moving average. And here I'm looking at the index shifted by 20 months. And what we see in these strong uptrends or the bullish phase of the 28-year cycle, we don't break below the shifted S&P. Here we don't break below. But where the 28-year cycle is bearish, sometimes we see some kind of a support or struggle around this level before we give up and collapse down. Here try to find support at this level before we were crashing. And going back to the previous 28-year cycle bearish phase, we see sometimes we have a quick crash below before we recover, but here the cycle was not yet quite bearish, but here we see we try to find support before we break below. Again here trying to bounce up and rally above this level, but failing and crashing down below. And I think we could already be in this topping or bearish phase of the 28-year cycle, and as we see in a couple of months here we could be in trouble. Actually, if we go down lower the coming months, we will get very close to this level, and then we could see a bounce and struggle to try to stay above, just as we would try to find support at the 40-month moving average and hoping, oh, that was it, that was the typical bear market in a strong uptrend. But we need a very strong bounce if we get down here somewhere, and we try to rally up to stay above this shifted S&P. So my expectation is we should go down short term a bit more, then try to rally in the summer, and then failing, breaking below this shifted S&P and flush down here. And my scenario for the S&P longer term, it's based on the two possible similar 28-year cycles from the 1850s and the 1940s. So here I have simply drawn the action from those two, the 1850s in red and the top around 1937, I think, 38, that's in green. So that's showing my general expectation. We see in blue, this is where we are now, and I think we could give up pretty much all the gains from the COVID lows. And that could be around early 2023 or late 2023. And the next cycle, 3.5-year cycle, that could be a bearish cycle. As we see, these two are kind of looking like bear flags. The red one, here the green one, looks like some kind of a bear flag. So normally what we see in these 3.5-year cycles is that a lower low is kind of bullish. You don't get a lower high will not produce a lower low. Like here, this was kind of a strange cycle top, but that didn't mean we were breaking down and getting a lower low. No, it was bullish. We hardly had any cycle low here, no bear market, so we were going up. Same in 2011, we had a lower high, and that didn't mean we were crashing down to a lower low. No, we hardly had any bear market here, and we turned up. And if you go to the 70s, here we had a lower high, but we didn't get a lower low. No, we hardly had any bear market, and we went up. So normally a lower high is kind of bullish. It means you are still not overbought, the market is not expensive, so there's not much downside. So the exception is where we have a really bearish 28-year cycle, like these two from the 1850s and 1940s. Here we see we have a lower high, and we get a lower low. In the 1850s in red, we have a lower high, and we get a lower low. So this would then suggest a deep low in around the year 2027. So we could give up all the gains from the COVID low, and then have a very weak 3.5-year cycle, and then crashing down. So I'm not expecting like a 90% crash from the highs, but we could go down to the level, S&P 2000 or something. And this is actually not the final 28-year cycle low. That's in the 2030s. But normally the next, what happens after this is more a kind of a sideways action into the year 2035, around there somewhere. So the most bearish part should be over in 2027. So pure speculation, we'll see.